Gold just printed a number the market wasn't supposed to see yet, and the dollar's entire strength story is now on a timer. Because while everyone is staring at the headline price, there's a quieter fight happening underneath it. The plumbing that decides whether gold is being bought because people are scared, or because the system is being forced to reprice trust. And if you catch that difference, you'll know what matters next week before the crowd does. What level becomes the trigger? What breaks if the dollar squeezes? And why the easy narrative about rates is about to betray a lot of traders. Here's the part that should bother you. Gold has been pushing into fresh record territory around the mid-4600s per ounce in recent days. And yet, the dollar keeps finding bids like nothing's wrong. That's not how most people think this movie is supposed to go. The simplified script says, dollar up, gold down, dollar down, gold up. But markets don't pay you for remembering slogans. They pay you for understanding the exceptions. And right now, the exception is the signal. Because when gold can rip higher, even with the dollar refusing to roll over cleanly, it's telling you the demand isn't purely weak dollar demand. It's something sturdier, something that can survive a dollar bounce. And that's where the real pressure starts. You can feel it in the way this move is being argued about. The official explanation is easy. Geopolitics, uncertainty, safe haven, end of story. But the real footprints don't look like a pure panic bid. They look like steady allocation behavior. Money that doesn't care if the next candle is red because it's not trading the day, it's buying the regime. And the next detail is what flips the whole setup. Watch what happens when the market tries to cool this off. We've already seen the pattern. A sharp push to new highs, then a fast smackdown, then a see, it's over chorus, and then it refuses to die. It grinds, it holds, it absorbs supply. That absorption is not vibes, it's mechanics. And if you understand the mechanics, you stop getting emotionally mugged by volatility, because volatility is the weapon here. The dollar uses it, gold uses it, dealers use it, funds use it, and the audience gets used by it. Not today. But that's not the part that matters. The part that matters is this. Gold trades in two worlds at once. One world is the paper world, futures, options, forwards, where billions can change hands in seconds with a keystroke. The other world is the physical world, bars, vaults, refining capacity, logistics, where nothing moves instantly and everything has friction. When those two worlds are perfectly aligned, you get normal pricing. The future price is basically the spot price plus the cost to carry the metal over time, funding, storage, insurance, minus whatever yield or convenience benefit you get from holding it. That's the boring textbook. But markets stop being boring precisely when the paper world and the physical world stop agreeing on what time should cost. That disagreement is the battlefield. Because when the curve starts behaving oddly, when near-dated contracts get stubborn, when spreads get jumpy, when the market starts paying up for immediacy, it's not just a chart pattern, it's a stress signal. It's the market whispering, I don't want promises, I want metal. And if you think that's dramatic, good. It should be dramatic. Because the dollar's power is built on promises. The entire system is built on promises. And gold is the asset you buy when you want something that doesn't need a counterparty to keep their word. But here's the key. The dollar doesn't have to collapse for gold to win. Gold only needs the dollar to become unreliable at the margin. That's it. It's a game of trust spreads, not apocalypse. And that's why this battle is heating up right now, quietly, in global markets, even as the headlines try to sell you a cleaner story. Now zoom out for a second and look at what's been happening under the surface of rates. In the last year plus, the US moved from a world where everyone expected higher for longer forever to a world where cuts have already happened, and the debate is about how many more and how fast, and whether inflation reaccelerates. That matters because gold doesn't trade off nominal rates the way casual commentary suggests. Gold trades off real rates, liquidity conditions, and the credibility of the policy path. And credibility is fragile when politics and geopolitics are loud. Even if you don't want to touch the political side of this, you can't avoid the market reality. When investors believe the central bank is cornered by inflation, by debt servicing, by growth risks, by political pressure, they start buying assets that benefit from policy uncertainty. Gold is the cleanest expression of that. And that's where people get trapped. They wait for the dollar to confirm by crashing. They wait for rates to confirm by plunging. And by the time the confirmation arrives, the move is already mature. Because gold is a front-runner asset. It sniffs the path before it's printed. But there's more. There's a calendar. And the calendar is not a suggestion, it's a catalyst. We're in the part of the year where positioning resets, liquidity can thin at weird moments, and monthly flows become a real force, not a footnote. Funds rebalance. Hedgers roll. Options dealers rehedge. Macro funds shift exposures around known event risk. And when a market is already stretched, the calendar doesn't just add volatility, it can turn a quiet imbalance into a loud squeeze. Because if one level breaks, the math changes. Think about how price actually moves in a modern market. It's not a democratic vote of opinions. It's a chain reaction of constraints. If price moves into an area where a bunch of options sit, calls, puts, barriers, dealers have to hedge. That hedging is not optional. It's risk management. If they're short calls, they buy futures or spot as price rises. That buying itself pushes price higher. That's reflexivity. Well, that's gamma. And when gamma shows up in the same neighborhood as a real underlying demand bid, central bank allocation, ETF allocation, physical tightness, price can gap and keep gapping, even while the story sounds too obvious to be true. And the next detail is what flips the whole setup. The people who think they re-trading gold are often trading dollar liquidity. Because in stress windows, the denominator is the weapon. When dollar funding gets tight, you can see weird things. Spreads blow out, basis moves, people sell what they can to meet margin, not what they want to sell. That's why you'll sometimes see gold dip sharply, even in a bullish regime. It's not the thesis died. It's somebody got a margin call. And if you can tell the difference, you stop confusing noise with signal. So what are the proof points that this is bigger than a headline blip? Let's stack them, because one argument is never enough in a market this crowded. First proof point, the fact that gold is making these kinds of highs at all and holding near them tells you demand is not shy. Price doesn't reach record prints in a deep liquid market without persistent sponsorship. That sponsorship can come from speculators, sure, but speculators don't usually sit calmly through pullbacks unless something else is supporting them. Second proof point, the institutional ecosystem around gold, ETFs, ETPs, managed accounts, has been showing that flows matter again. When ETFs are accumulating, that's not a day trade. That's an allocation decision. It's slow money choosing exposure. And once slow money chooses exposure, it doesn't flip on a single headline. Third proof point, official sector behavior. Central banks have been meaningful buyers over the past few years compared with the pre-2022 world. And even when the pace slows from a torrid level, the floor under that demand has been hard to ignore. Those purchases aren't chasing memes. They're changing reserves composition. They're hedging sanction risk, settlement risk, and the long-term direction of trust. Fourth proof point, the supply chain reality. Gold supply is not a tap you turn on. Mining is slow, permitting is slow, capital spending is slow. Even when prices scream, production doesn't double next quarter. Refining and logistics are real constraints. Recycling helps, but it's not infinite, and it's price sensitive. That means demand shocks matter more than casual observers think. Fifth proof point, cross-market behavior. And when multiple metals are moving together, when silver, copper, tin are also making aggressive moves, it can indicate more than fear. Sometimes it's a broader repricing of hard assets. Sometimes it's a stockpiling behavior. Sometimes it's a hedge against policy outcomes. Sometimes it's a supply chain or trade friction story. In any case, it's telling you the inflation and uncertainty complex is alive, not dead. And that's where the real pressure starts. Now let's tighten the lens to the dollar side, because gold versus dollar isn't a philosophical debate. It's a flow fight. The dollar is the world's funding currency. When the dollar is scarce, everything else feels heavy. When the dollar is abundant, risk assets levitate. Gold sits in a weird place. It can suffer in a dollar liquidity squeeze in the very short term because margin calls for selling, but it can thrive in the medium term because people start distrusting the very system that creates the squeeze. That's why gold can be whippy and still bullish. That's why you don't marry the daily candle. You marry the mechanism. So what's the hidden detail that reframes this whole story? Here it is, clean and simple. The curve is the battlefield because it decides whether holders get paid to wait or paid to grab metal now. In a normal world, the futures curve for gold is gently upward. Future prices slightly above spot, reflecting the cost of carry. If you can buy spot, store it, and sell a future, you lock a small return. That's contango. It's boring. But if the market starts doing the opposite, if near-term contracts get relatively expensive, if spreads tighten, if the convenience yield of holding physical rises, that tells you something. It tells you that immediate access has value. It tells you the market is willing to pay up to avoid waiting. And when that happens, paper claims are still paper claims, but physical becomes a premium asset. Not because of a cartoon conspiracy, because of incentives, because of risk management, because of settlement preference, because if you're a large player and you're worried about delivery windows, collateral stress, or liquidity dislocations, you don't want theoretical exposure, you want clean exposure. And clean exposure often means you care about structure, not just price. This is where the mainstream misses the signal. They'll show you a gold chart and talk about fear. But the market S, real tell, is in the spread behavior, how futures months price relative to each other, how forwards price, how the trade between London and New York behaves, how the premium for immediacy rises or falls. When those relationships move, it's like seeing the ocean pull back before a wave. The crowd is watching the beach. The pros are watching the waterline. And the next detail is what flips the whole setup. Those spreads force behavior. If the curve pays you to hold metal and sell forward, you get one set of flows. If the curve stops paying you, or worse, starts penalizing you, you get another set of flows. Dealers adjust inventories. Vault holders decide whether to lease. Funds decide whether to roll or hold. Refiners decide which bars move where. And each of those decisions pushes on price discovery. That's why paper versus physical tension isn't a meme. It's an actual set of incentives that can tighten or loosen the market without a single dramatic headline. Now layer in the calendar, trigger again, because timing turns incentives into action. Around major event risk, central bank meetings, month-end rebalancing, options expiration windows, liquidity can thin, and thin liquidity magnifies forced flows. If a market is close to a key level, like a record high zone, there are two kinds of participants watching it. The first kind is the storyteller, waiting for a headline to justify a buy. The second kind is the risk manager, watching a level because it changes their exposure whether they like it or not. And guess who moves markets in the short run? Not the storyteller, the risk manager. If a level breaks and dealers need to hedge, they buy. If a level breaks and shorts are trapped, they cover. If a level breaks and trend systems flip, they buy. Those buys are not opinions, they are forced. And forced buying is how markets gap. But that's not the part that matters. The part that matters is what comes after the gap, whether it holds, whether it retests, whether it turns the previous ceiling into a floor. That's where you see whether sponsorship is real. So let's talk about sponsorship. Who is actually supporting gold here? There are multiple layers, and that's why the move has been so persistent. One layer is central banks and sovereign style demand, reserve diversification, settlement risk hedging, long-term trust hedging. Another layer is institutional portfolios. When equity valuations feel fragile and bond returns are uncertain, gold becomes a volatility dampener, a non-credit asset, a portfolio insurance instrument. Another layer is the macro crowd, people trading real rates, policy credibility, currency stress. Another layer is the options ecosystem, dealers hedging, funds chasing convexity, momentum systems responding to breakouts. Another layer is the physical market, jewelry demand in some regions, bar and coin demand in others, and the logistics of moving metal across regions when premiums appear. When you stack those layers, you stop needing a single perfect narrative. Because markets this big don't move on one reason. They move when multiple reasons align just enough to create persistent imbalance. And the dollar? The dollar is fighting this on two fronts. Front one is the obvious front, higher relative yields and safe haven demand for dollars during stress. Front two is the quieter front, credibility. Because the dollar's dominance is not only about interest rates, it's about rule of law, institutional stability, and the belief that the system won't be weaponized unpredictably. When that belief gets noisy, even if nothing breaks, the marginal buyer starts diversifying, and the marginal buyer is the only buyer that matters for price. This is why you can see a world where the dollar stays firm in the short term, especially during risk-off, while gold also rises. It's not a contradiction, it's a diagnosis. The world wants dollar liquidity and dollar safety at the same time, and it's starting to differentiate between them. Liquidity is the dollar. Safety, increasingly, is not only the dollar. And that's where the real pressure starts. Now, I need to hit the counterpoints, because this is where trust is earned. Gold can absolutely get punched in the face from here. In fact, if you've watched gold for any length of time, you should almost expect it. Record highs attract profit-taking. They attract systematic selling from rebalancers. They attract fade-the-move traders. And if the dollar catches a short squeeze, say risk assets wobble or yields pop, or surprise data print shifts rate expectations, you can get a sharp downdraft in gold even if the longer thesis remains intact. Also, if geopolitics cools suddenly, some of the headline bid can fade. And if central banks signal a less accommodative path than markets priced, you can see a repricing of real rates that hits gold. Those are real risks. But here's the trap. Short-term pain does not equal invalidation. You need rules. You need a framework. You need to know the difference between trend signal and noise. Trend signal is what the market does around key levels after the volatility. Noise is the intraday whip that exists to harvest weak hands. And weak hands are not an insult. They're a role in the ecosystem. The market feeds on emotional liquidity. It needs people to buy high and sell low so that stronger hands can accumulate. That's why your psychology matters as much as your thesis. Because volatility is designed to make you betray yourself. It will spike up and make you chase. Then it will slam down and make you panic. Then it will grind sideways until you get bored and leave. And then it will move without you. That is the oldest trick in financial markets. And it still works because humans haven't changed. So here's your viewer psychology shield. And it more is simple. Decide in advance what you re-watching and what you re-ignoring. If your thesis is gold is repricing trust versus the dollar, then the things you watch are not every headline. The things you watch are structure and behavior. Does gold hold above prior breakout zones after pullbacks? Do dips get bought quickly, or do they bleed out for days? Do spreads in the curve behave like they're urgency or like they're plenty of slack? Do ETFs show persistent accumulation or persistent distribution? Does the dollar bounce violently and fail to dent gold meaningfully? Or does gold fold the moment the dollar twitches? Those are tells. Those are regime tells. And the next detail is what flips the whole setup. You also watch how the market treats bad news versus good news. In a bull regime, bad news doesn't push price down for long, and good news pushes it up fast. In a bear regime, good news can't lift it, and bad news crushes it. That's a behavioral diagnostic. Use it. Now let's get concrete about what comes next, because gold versus dollar is not a bedtime story. It's a tradable tension, and the near-term roadmap is where you either stay ahead of the crowd or get dragged behind it. Here's the clean way to trade your attention. 2 scenarios, 2 checklists, 1 line that tells you which world you're in. Scenario 1 is the controlled pullback and retest. In this scenario, gold chops after the record print. It pulls back, maybe sharply, maybe in a few waves. People declare the top, then it finds support near the breakout zone, think the most recent consolidation area below the highs, and it holds. It doesn't have to be pretty. It just has to stop bleeding and start absorbing. In that world, the bull thesis remains intact because the market is digesting gains, transferring supply from late chasers to stronger holders, and setting up the next push. And what confirms scenario 1? Quick recoveries from sell-offs, higher lows, and crucially, the inability of a dollar bounce to force a sustained breakdown in gold. If the dollar rallies for a week and gold just shrugs, that's sponsorship. That's real. What weakens scenario 1? If gold loses a key support zone and can reclaim it quickly, if it starts making lower highs and lower lows while the dollar firms, then the market is telling you the move was more fragile than it looked. Not dead forever, but fragile. And you adjust. You don't argue. You adjust. Scenario 2 is the continuation, squeeze, and gap risk. This is the cinematic one, and it's the one that punishes people who wait for confirmation. In scenario 2, gold doesn't give the market a polite pullback. It consolidates tight near the highs. Volatility compresses, liquidity thins, and then a catalyst hits. An event risk surprise, a funding stress flare-up, a sharp move in rates, a geopolitical escalation, or simply an options-driven reflexive move, and price gaps higher. In that world, the market isn't moving because everyone suddenly believes. It's moving because positioning gets cornered. Shorts cover, dealers hedge, trend systems flip, and the move accelerates. What confirms scenario 2? Breakouts that don't retest, strong closes into the end of the week, intraday dips that get instantly bid, and a curve spread behavior that suggests urgency rather than complacency. What invalidates scenario 2? A breakout that immediately fails, or price spikes and then collapses back into the prior range and stays there. That's a bull trap signal in the short term. It doesn't kill the long-term case, but it changes the week's posture. Because if this one level breaks, the math changes, and if it fails, the math changes the other way. Now notice what I did there. I'm not giving you a magical price target that guarantees anything. I am giving you a map of behaviors and levels that tell you which regime you are in. That's how you stay sane. That's how you stop being emotionally rented by volatility. And yes, you need the risk reminder spelled out. Price can whip around violently even if the thesis is correct. Gold can drop hard on a dollar squeeze. Gold can spike and then retrace on profit taking. Gold can do both in the same week. The thesis is not line goes up smoothly. The thesis is the market is repricing trust versus the dollar, and that repricing expresses itself through structure and flow. If you can hold that distinction, trend signal versus noise, you stop getting played. Now, let's talk about what you should actually watch in the next week or two, the stuff that tells you the battle is intensifying or cooling. First, watch the dollar's behavior around stress. If risk wobbles and the dollar spikes, does gold collapse or does it hold? That's a massive tell. Second, watch real rates and inflation expectations, not as headlines, but as directional pressure. If real yields rise and gold still holds, that's telling you demand is not rate sensitive in the usual way. Third, watch positioning proxies. Do you see signs of forced buying, fast vertical moves, heavy volume around breakouts, sharp reversals that don't follow through lower? Fourth, watch ETFs and allocation chatter. Not because you're copying it, but because it tells you whether slow money is adding or trimming. Fifth, watch the curve and the spreads. You don't need a Bloomberg terminal to understand the concept. If the market starts valuing immediacy more, that's a stress signal. Sixth, watch the physical side in your own world. Are premiums widening? Are products harder to source? Are delays increasing? That's not a perfect indicator, but when it aligns with the paper signals, it matters. And the next detail is what flips the whole setup. Pay attention to the calendar choke points, major policy meetings, month end, options expirations, delivery windows. These are moments when the market is forced to choose, not just talk. And forced choices move price. Now let me be very clear about what I'm not saying, because this is where people get reckless. I'm not saying gold is a guaranteed one-way bet. I'm not saying the dollar is dead. The dollar can rally brutally. In fact, the more people get positioned for dollar weakness, the more violent the countermove can be. That's how markets punish consensus. So the posture here is not blind bullishness, it's alertness. It's seeing the silent battle and refusing to be surprised by the next act. Because if gold is truly repricing trust, while the dollar remains the world's liquidity engine, you can get a world where both rise at different times for different reasons. That's confusing if you live in slogans. It's profitable if you live in mechanisms. And that's where the real pressure starts. So here is the simplest way to summarize the whole thing without dumbing it down. Gold is not merely reacting to headlines, it's responding to incentives in market structure, and those incentives are being shaped by policy credibility, global stress, and the calendar. The hidden detail is the curve and the time pricing of metal, whether the market is paying you to wait or paying you to secure exposure now. The dollar is not a cartoon villain, it's the denominator. And when the denominator becomes unstable at the margin, even emotionally, even politically, even structurally, gold's bid strengthens in ways that don't require a dramatic dollar crash. That's why this fight can heat up quietly and still explode suddenly. Because in markets, quiet tension is often the precondition for loud repricing. Now, before we land this, I want to give you one more tool for staying rational when the tape gets violent, because it will. When you see a big red candle in gold, ask one question before you do anything. Did something break, or did something delever? Break means the market failed to reclaim a key level and behavior changed. Delever means someone sold because they had to, and price snapped back when the forced flow ended. You can't always know in real time, but you can watch the follow-through. Forced selling often reverses quickly and leaves a wick. Structural breaks often drift, retest, and fail. That's the difference between getting shaken out and getting saved. Use it. If you like markets explained like systems, not slogans, you're already in the right room. Stick around for the next updates, because the next week or two is where this turns from a headline story into a positioning story. And positioning stories move faster than people expect. The quiet battle is already on. Watch the curve. Watch how gold behaves when the dollar flexes. Watch whether the market pays up for immediacy. And above all, don't let volatility steal your plan.